Dan, great to get you on. So let's begin with the conversation around the Fed. Do you think markets are primed for liftoff, even though we still don't necessarily have any resolution or de-escalation when it comes to the war in Ukraine? Good morning to you, sir.
Good morning, Dan. Well, I mean, I'd say that the survey results surprise me, that the CMB survey results surprise me that the bulk is looking for 5+, because I think that over the past 4 weeks, the macroeconomic assessment has changed somewhat. 4 weeks ago, I think most macro strategists would have been out saying, we're going to see a slowdown in growth, but growth remains robust. And risk assets can really stomach a number of rate hikes, and we could see 5+, anywhere between 5 and 7 rate hikes. But over the past 4 weeks, we've got a war, and we've got now lockdowns also in China. So those two factors really do up the risk of going into a recession from being a really small outlier scenario to being something that we need to take closer or pay closer attention to. So I would say that the Fed is probably going to have a hard time hiking 5 times this year, especially if the lockdowns start to get tighter in China. You can't just have lockdowns in the world's second largest economy and not expect to have a knock-on effect for global capital markets and risk assets. And then, of course, also the pathways that we have towards a potential de-escalation in Ukraine are very important for us to understand what then the potential second round effects will be for capital markets and risk assets. Because war is inflationary, and this war in particular is inflationary. And so because of the aspects on the commodity markets. And so from that perspective, central banks are in a very tricky place. Inflation is high. They need to act at the same time. Knocking the global economy into a recession is definitely not the pathway they're looking for.
That's exactly right, Dan. And you make an excellent point here regarding how inflationary this war has been. In terms of some of the other inflationary factors, like higher energy prices, for example, and of course, issues within the supply chain, will a Fed hike necessarily address those? I would contend no. So what does that mean moving forward for the rates outlook stateside if we continue to see inflationary pressures rising as a result of factors that are totally beyond the Fed's control?
Yeah, Dan, of course, you're totally right. Raising interest rates does not have a direct impact on oil prices. Oil prices are determined by supply and demand. However, don't forget that oil prices are political. Oil prices mean higher gasoline prices at the pump. And the reason why Biden's approval ratings are so low is in no small part due to the fact that consumers in the U.S. are seeing their pocketbooks shrink because of the inflation that they're witnessing. They're seeing it in food price inflation, but they're also seeing it at the petrol pump. And this is a very sensitive area for voters in the U.S. So there's going to be political pressure for central banks to do something to bring prices down. Now, whether central bank tightening of monetary policy is really going to have an impact on commodity price inflation, that remains to be seen. It shouldn't have a direct impact at all. But demand destruction is, of course, a consequence when you have tightening monetary policy. Demand destruction will bring prices of commodities lower. Look, I think OPEC is monitoring this situation very closely, and they really do not have an incentive to see demand destruction start ruining the volume for oil sold. So if they felt that high oil prices are starting to slow down demand for oil, then they would increase output to bring oil prices lower. So from that perspective, I think right now the global economy is actually still strong enough to stomach these higher oil prices and companies to pass on higher input prices to the consumer. But we're at we're at the cusp here. We're really at a pain threshold. Because as a company, you can pass on up to 10% higher prices when you have strong consumer demand. That's okay. But you can't pass on 30% cost inflation. That doesn't work. That will tip you into a recession. So it's really at the edge here in terms of where we stand on inflation.